Imagine a company so powerful, so innovative, it seemed to defy the very laws of business. A titan of the new economy, crowned America's most innovative company by Fortune magazine for 6 years straight. This was Enron. At its peak, it was the 7th largest corporation in the US, with a market valuation soaring past $65 billion. Wall Street analysts praised its seemingly endless growth and charismatic leadership, calling it the future of energy. Investors poured their life savings into its stock, believing they were backing a rocket ship to financial prosperity. But what if that rocket ship was just a sophisticated illusion? Behind the glowing press releases and soaring stock charts, a dark secret was festering. Enron wasn't built on solid ground. It was a house of cards, meticulously constructed with accounting fraud. Its dazzling profits weren't real. They were phantoms, conjured from complex shadowy partnerships and audacious accounting tricks that would later become legendary. The entire empire was a performance for an audience of eager investors and a fawning financial press, a multi-billion-dollar lie. And in late 2001, the performance came to a sudden, catastrophic end. The illusion shattered. In just a few months, the corporate giant imploded, its stock price plummeting from over $90 a share to less than $1. The $65 billion valuation vanished, taking with it the jobs and retirement savings of over 20,000 employees. The collapse sent shockwaves through the global financial system, shaking public trust in corporate America to its core. It became a cautionary tale of epic proportions. How did it all go so wrong? This is the rise and fall of Enron. To uncover the full story of the masterminds behind the fraud and the victims they left in their wake, you're in the right place. Before we dig deeper, subscribe to Finance Code for more real breakdowns of the world's biggest financial stories. The story begins in 1985, with the merger of two relatively unremarkable pipeline companies, Houston Natural Gas and InterNorth. The new entity, Enron, was born. At its helm was the charismatic Kenneth Lay, a man with a PhD in economics and a grand vision. He didn't just want to transport energy, he wanted to trade it. He envisioned a world where energy, like stocks or bonds, could be bought and sold on an open market. This vision truly took flight with the arrival of Jeffrey Skilling, a brilliant but ruthless Harvard Business School graduate. Skilling proposed a radical idea, the gas bank. Enron would act as an intermediary, buying gas from a network of suppliers and selling it to a network of consumers, guaranteeing both supply and price. They weren't just a pipeline company anymore. They were creating a market from scratch. Wall Street was utterly captivated. Enron's revenues exploded, and it quickly diversified, trading everything from electricity and broadband internet capacity to weather derivatives. Fortune magazine named it America's most innovative company for 6 years in a row. To the outside world, Enron was the future, a new economy titan that couldn't be stopped. By the year 2000, its market value swelled to nearly $70 billion, making it one of the largest and most admired corporations in America. But this glittering facade concealed a dark and complex secret. The spectacular growth was an illusion, meticulously crafted through accounting fraud. A key tool was mark-to-market accounting. This aggressive and, in Enron's case, fraudulent application allowed them to book estimated future profits from long-term contracts the moment a deal was signed. A 20-year deal could be counted as immediate profit, even if not a single dollar had actually been received. Projected earnings became reported income, painting a picture of phenomenal yet entirely fictional profitability. To hide the mountains of debt generated by failed ventures and bad bets, Chief Financial Officer Andrew Fastow engineered a labyrinth of off-balance sheet entities. These thousands of shell companies with bizarre names like Raptors and Jedi were used to absorb Enron's liabilities. The debt didn't disappear, it was simply moved into these financial black holes, keeping Enron's official books looking pristine. On paper, losses were magically transformed into profits, fooling regulators, analysts, and the entire investment community. Investors, blinded by the ever-rising stock price and the glowing analyst reports, poured their life savings into the company. The hype was intoxicating. Employees were encouraged to invest their retirement funds in Enron stock, believing they were part of an unstoppable success story. In August 2000, the stock reached its zenith, trading at an all-time high of $90.75 per share. The celebration was on, the executives were heroes. But a structure built on lies cannot stand forever. The first major crack appeared in August 2001 when Jeffrey Skilling, the architect of Enron's success, abruptly resigned, citing personal reasons. The market shuddered. Internally, Vice President Sharon Watkins had already sounded the alarm, writing a now famous anonymous memo to Ken Lay, warning that the company was an elaborate accounting hoax and could implode in a wave of accounting scandals. The house of cards was beginning to tremble, and the world was about to witness the most spectacular corporate collapse in history. The house of cards, so meticulously constructed, was swaying. The final gust of wind came in late November 2001. A last-ditch rescue merger with rival Dynegy collapsed as the true horrifying scale of Enron's hidden debt became undeniable. Days later, credit rating agencies, which had been slow to react, finally downgraded Enron's debt to junk status. It was a fatal blow. The company, once a titan of the energy market, was now a pariah, unable to secure the credit it needed to function for even another day. The end was no longer a possibility, it was an inevitability. On December 2, 2001, the inevitable arrived. Enron filed for Chapter 11 bankruptcy protection. With over $63 billion in assets, it was the largest corporate bankruptcy in American history at the time, a record that would shockingly be surpassed just a year later by WorldCom. The news sent a seismic shock through Wall Street and the global economy, a stunning confirmation that one of the most admired companies in the world had been a complete and utter fraud. But the true devastation wasn't measured in assets or stock prices, it was measured in shattered lives. Roughly 20,000 employees were laid off, many with little to no warning. They walked out of the Houston headquarters carrying their lives in cardboard boxes, their careers vaporized. Worse, many had their entire life savings tied up in Enron stock through their 401k retirement plans. During the final frantic weeks as the stock price plummeted, a lockout period prevented these employees from selling their shares, forcing them to watch helplessly as their nest eggs, worth millions on paper, dwindled to absolutely nothing. Meanwhile, top executives had already cashed out hundreds of millions of dollars in stock. For investors around the world, the result was just as catastrophic. Billions upon billions in shareholder value were wiped out, seemingly overnight. The stock, which had traded at over $90 a share just a year earlier, was now worthless, delisted from the New York Stock Exchange. The pride of Houston, the symbol of a new asset-light economy, had become a penny stock, a testament to the biggest corporate lie ever told. The fallout was swift and severe. The U.S. Department of Justice formed an Enron task force, launching one of the most complex white-collar crime investigations in history. The architects of the fraud faced their day in court. CEO Ken Lay and his successor Jeff Skilling were convicted of fraud and conspiracy. Lay died of a heart attack before his sentencing, but Skilling would go on to serve over a decade in federal prison. CFO Andrew Fastow, the mastermind behind the deceptive special purpose entities, pleaded guilty and became a key witness for the prosecution, receiving a reduced sentence in exchange for his testimony against his former bosses. The scandal's blast radius extended far beyond Enron's executive suite. Arthur Andersen, once one of the Big Five global accounting firms, was found guilty of obstruction of justice for shredding tons of Enron-related documents. The conviction was later overturned by the Supreme Court, but it was too late. The firm's reputation was destroyed, its clients fled in droves, and the 85,000-person company effectively dissolved, a stunning casualty of its complicity. To prevent such a disaster from ever happening again, the U.S. Congress passed the Sarbanes-Oxley Act in 2002. This landmark piece of legislation fundamentally changed the rules of corporate governance. It created powerful new oversight boards, mandated stricter internal controls, and most importantly, required CEOs and CFOs to personally certify the accuracy of their financial reports, holding them directly and criminally liable for fraud. The era of plausible deniability was over. So what can we, as investors, employees, and citizens, learn from Enron's spectacular fall? The lessons are as relevant today as they were 2 decades ago. First, if something seems too good to be true, it almost certainly is. Enron reported quarter after quarter of impossibly smooth, predictable, and ever-growing profits. In the volatile world of energy trading, this should have been a massive red flag. But the market, addicted to the story, chose to believe. Second, transparency is not a buzzword. It must be a non-negotiable foundation of business. Enron used complexity as a weapon, weaving a web of thousands of off-balance sheet entities to hide its debt and deceive investors. True financial reporting should be clear, honest, and accessible, not a puzzle designed to mislead. And third, Unchecked greed may build empires, but it is also the force that inevitably destroys them. Enron's culture, driven by the ruthless rank-and-yank system and astronomical bonuses tied to fraudulent profits, incentivized winning at any cost. This culture rotted the company from the inside out. Ultimately, Enron's story is a timeless and chilling warning. It's a warning about the dangers of unchecked ambition, the corrosive power of deceptive accounting, and the catastrophic consequences of blind trust in markets, personalities, and ever-rising stock prices. Understanding these stories is crucial to navigating the financial world. If you found this breakdown useful, hit subscribe and join us here at Finance Code for more deep dives into the biggest financial stories in history.